So case study, if you make 100 grand or 150,000, you can get some good deductions. If you adjust gross income is $100,000, you can write up to $25,000 of passive losses against your W-2 active income. And there's no additional requirement. You do not need to be a real estate pro. You do not need to be short-term tax loophole, nothing like that. Straight up. Okay. You can become you can use a professional property manager and all that. If you make 100 grand or less, you can write off up to $25,000 of passive losses against your W-2 income. That's a huge savings potential. If you make anywhere from 100 grand to 150,000, that's offsetting write-off. You get some partial deductions on a current tax year. But if you make more than $150,000 adjusted gross income, a single and married filing jointly, all your passive losses cannot be offset by the current year's passive income, because that's the rule, right? All your depreciation and passive losses on the current year fully would be suspended indefinitely to the future years if you make more than 150K or more, unless you do the short-term rental tax loophole, or unless you do the real estate professional status. Am I very clear? Okay. I will go over to short-term tax loophole momentarily. Then after that, the real estate professional tax status. Does it make sense? Some of the housing market I'm showing you, this is South Texas, a very desirable place to invest. They have fourplex for 540K, those kind of things. And you can review the screenshot when you get the webinar replay back to you. I will email you the Zoom replay in a few days, next week sometime. I'm going to use the sample tax return using this particular property, this fourplex, okay? Just so you know. All right, how to calculate depreciation. Here we go. This is important. So that very same fourplex we just discussed, 540K, 20% of a property is usually land's not depreciable. So you take off, around 20%. So land is not depreciable, so you deduct the land component is 109, which is 20% of 545K. So therefore, your basis to calculate depreciation on a residential investment property, let 4 units or less, in this case, 436K. Does it make sense, right? The traditional depreciation method most people know about are 4 units or below. You can depreciate over 27 and a half years. If you own a commercial real estate property, which is 5 units or above, the depreciation method is 39 years. So personally, I like 4 units and below, because 4 units and below, you get the favorable 30-year fixed rate loan under the Fannie Mae lending guideline. Furthermore, the 4 unit and below, you can depreciate the property over 27 and a half years. In this case, in this fourplex situation, simple math, right? 436K divided by 27.5 years equals, you get paper loss depreciation every year of $15,854. Straight line depreciation, 27 and a half years. So let's apply that property situation on your Schedule E tax return. So this is your gross rent, right? I plug it right off the pro forma, which I already show you. Everything's just clear cut, right? All the expenses, gross rent minus expenses minus the paper loss depreciation, year by year, 15,854. Everybody get that, right? Equal at the end of the year, this particular property, instead of paying ordinary taxation on $64,000 of annual rent on this fourplex, after the deductions, after the paper depreciation of $15,854, equal your net profit of $11,922. So this $11,922 will be carried over into your federal tax form, page 1 of your federal tax return under adjustments to income. So this $11,922 is subject to ordinary taxation, whatever the ordinary tax bracket that you are categorized under, whatever your money you make, right? So how cool is that? So instead of paying 64 grand and subject to ordinary taxation, or you're on paper, you're just paying 11,922 subject to ordinary taxation tax. So you're saving tons of money just by owning an income property. And if you make 100 grand or make it slightly more than $100,000, you can get this full deduction, right? 15,854, because you know the previous rule, you can deduct up to $25,000 of passive losses against your active income if you make 100 grand or less. If you make 100 grand, between 100 grand and 150,000, there's a phase out, $2 for $1, any amount above and beyond 100 grand, up to a point where we make more than $150,000, all your passive losses, you cannot deduct against your gross income, gross rent. You have to carry forward indefinitely into the future tax years to offset against the future passive income from other passive income activities you have. Does that make sense? Okay, cost segregation, okay? Now, some of you are thinking, oh, don't go through the traditional route. Okay, you can do a cost segregation whereby you could hire an engineering firm, not a CPA, an engineering firm, where you pay them whatever $1,000. You pay them a fee so they can help you create a cost segregation study whereby instead of traditional 27.5-year write-off, they can break down certain components within the property where you can accelerate the depreciation more. For example, they have this rule book. It shows where, okay, that's fine. The steel structure, the roof, the walls, the doors, the windows, HVAC system, they are still under 27.5 years write-off period, which is slow, steady, not the best write-off, right? But if the cost segregation engineering study allow those kind of companies to break down the components of your property, the land improvement aspect is a 15-year accelerated write-off. Parking lots, curb, gutter, storm drains, irrigation system, retaining walls, tree shrubs, whatever, okay? And then finally, even better, you have 5 to 7 year accelerated write-off on these items that depreciate quicker because they are wear and tear. So they have a 5 to 7 year accelerated depreciation write-off based on a cost seg study, which is carpet, countertops, cabinetry, blinds, windows covering, lighting, plumbing, window treatments, wall covering, the whole 9 yards. Okay, let's see what else. I already briefly talked about the bonus depreciation. There's a gradual phase out unless Congress, they will restore the 100% bonus of the depreciation. But the year over year, as you can see, this year you can only claim 40% bonus depreciation, which is fine. Now that it goes 100%, again, when Congress, hopefully soon, going to restore the 100% bonus depreciation, you get more deduction from your income properties. But you have to own those properties first. That's why I inspire you to start buying rental properties as soon as possible, okay? Because what's the purpose of learning tax strategies if you have no properties to apply the tax strategies, right? It's just, of course, I'll help you on that, right? Come out and reach out to me and I'll help you. All right, so let me see what else. Again, cost segregation, 3, 5, 7 year, 10 year, 15 year, accelerated depreciation instead of straight line 27.5, right? So let's go back to the fourplex $549 purchase and apply the cost segregation scenario. Okay. Oh, that will come later. Actually, no, hold on. Oh, that's right here. See? So the question you have is, okay, you pay $1,000 whatever money for the engineering firm to conduct a cost segregation, okay, using accelerated depreciation. At the end of the day, whatever is the price of the property minus the land component, you can pretty much, I'll make it simple, okay? I don't want to bog down with the calculation. When you do a cost segregation, you can get anywhere from 35 to 40% write-off. That's the benefit. That's a huge benefit. Okay. Now, what if you buy the income rental property only cost like $100,000, $150,000, or even $200,000? That price point of that purchase, you should not justify paying the firm $1,000 or even $2,000 to do the cost segregation study. Why? Because the tax savings from a lower price property may not justify pay the fee to do the cost segregation. So what I'm trying to say is, unless your rental property purchases at least $300,000, $400,000, maybe even $500,000, the higher the better. The higher the price point that you bought, as in the case I just showed you, this fourplex, this is ideal. This fourplex purchase, $545K, is ideal to do cost segregation because the actual tax savings justify the fee you pay to the cost segregation company. Does it make sense? And let me tell you, so essentially, to make the long story short, by doing the cost seg on this fourplex 549K property, let's use an arbitrary 35 to 40% deduction from the cost seg. 30 to 45% deduction based on the result of the cost segregation study. 40% multiplied by 549K, I came up with $28,000. So doing the cost seg study, you're able to deduct $28,000 on that particular tax year, on the year of purchase. Instead of the slow 27.5 year straight line depreciation, you get 15,854, right? You're getting double the amount of deduction, 28,000. So you do the number. Okay, let's do the math. You carry forward the same gross rent, the same deductions, the same everything, except the depreciation is double the amount using this cost seg. So the effect is such that you have much more write-off. Okay, instead of $76,000 write-off with this straight line depreciation, you got an $88,000 write-off with this cost seg. Then you have a passive loss. Then you have a paper loss of $24,000. You have more paper loss. If you make $100,000 or less than $150,000, you could potentially write this $24,000 paper loss using this cost seg study to offset against your W-2 income. So your W-2 income, let's say, is $100,000. $100,000 subject to a 25% tax bracket minus $24,000 passive losses. Okay, equals $76,000 AGI, adjusted gross income, subject to ordinary taxation. So we're talking our savings, the $24,000 of passive losses multiplied by your tax bracket of 25%, right? So 25% multiplied by $24,000 of passive losses equals like $5,000 of additional tax refund coming into your pocket. Does that make sense? You pay approximately $1,000 for the cost seg study. You're getting a net return of $5,000. $5,000 minus $1,000, you get a net gain of $4,000. Pure dollar for dollar, $4,000 net gain into your pocket for that tax year that you did the cost segregation study. Is everybody clear? I could not explain to you in any other simplistic way. Okay. And then we could talk about real estate professional status momentarily, okay? Just hold that thought. I'm going to segue into, woo, you guys get it? Okay. I hope you do, because I'm trying my best to explain to you in a layman's terms, not the technical terms if I were a CPA or tax attorney or whatever, okay? Because it'll go over your head because they don't know how to explain to you.